Thank you, Mr. Chair, and thanks, Mr. Chopra, for being here. I want to talk just a little bit about the SVB collapse, and particularly the way in which the San Francisco Fed failed to successfully address that situation. So, just to sort of ask on the three major bank failures we've had this year, Mr. Chopra: First Republic, SVB, and Signature. Who were the primary regulators of the three banks?
So the Federal Reserve of Silicon Valley Bank at the federal level, the FDIC at Signature Bank and First Republic. Two were California state chartered banks. One was New York.
Okay, thank you. So one question is, do you know the last time an OCC regulated bank failed?
A large one, I believe, has not failed in some time.
Yeah, so I think the last one was 2019. It was a pretty small bank, didn't require some of the extraordinary measures that you guys took in response to the SVB and First Republic collapse. So here's, I guess, my basic question here. I've heard this from industry people, and you always have to be somewhat skeptical when you're talking to industry people. Obviously, they have their own self-interest, but on this issue, I think they're clearly right, that the Fed is both an over-burdensome regulator, but also a very ineffective regulator, that they take up a lot of time and don't actually do a whole lot to make the banking system safe. I'm wondering if you have a view on that. Is the OCC a better regulator than the Federal Reserve? Maybe I'll just ask that question directly and sort of get your view there.
I think it depends. It's hard to say overall, but I will tell you, I think if we were starting from scratch, we probably would not create this balkanized system of who's accountable for oversight. From my viewpoint, as having backup supervision on consumer for all types of banks, including large banks and others, as well as from the FDIC board, I do think inconsistency and supervisory approach, does have costs.
Yeah. So I guess the question that I have is, given what you just said, and I agree with you, if we were to create this system fresh, we probably wouldn't design it in the way that it looks now. This is sort of some combination of bureaucratic capture and the various ways in which we reform the system over time. Could you speak to the potential efficacy of moving part or even all of the Fed's supervisory power over to the OCC?
So the last experiment we had with this was really the CFPB. The Fed's authorities were largely stripped on consumer, and I think we've actually created, maybe not everyone likes it, but a huge amount of consistency throughout the board. So I think we would, if you wanted to create consistency, there's many ways to do that, but I don't have deep insight onto the Fed's supervision on the prudential banking side. But inconsistency is not good.
Yeah. So we're going to look into potentially some legislative changes here that I think would make the banking system both more safe and lower risk for consumers and taxpayers, but also would actually be more efficient from the perspective of industry. I really worry here that we've somehow created a system that is both overly burdensome on the financial institutions, including and especially those that are doing the right thing, and is simultaneously really, really ineffective at preventing systemic risk. We'll certainly have more questions and more conversations in the weeks and months to come as we develop that policy. I want to close by just making an observation, and feel free to respond, though I recognize we're getting down on time here, Mr. Chopra. You said at let me get the organization, I think it's the American Economic Liberties Project, in a speech on May 4th, that you were really concerned about concentration and bigness in the financial sector. And I think probably more than many of my colleagues, I share that concern about bigness in the financial sector. But I do have some concerns that the actual policies of the last couple of years have heightened that problem, not lessened it. In particular, we of course, as I understand it, there was a bidding process for First Republic. PNC, much smaller bank, still a large financial institution, but a much smaller bank, and JP Morgan both submitted bids. And of course, JP Morgan's bid was accepted. My understanding is that increased JP Morgan's depositor base by, if you combine everything that's happened in the last year, by close to $100 billion. That strikes me as a really bad deal for consumers, a really bad deal for the risk of our financial system, but a really good deal for JP Morgan. And so as you guys go about your work over the next couple of years, and certainly as we go about ours, I would love for us to pursue policies that actually preserve and strengthen the three-tiered banking system rather than make JP Morgan more and more powerful which is what it seems that we're doing right now.
And certainly many banks personally raise concerns that it seems obvious that we have a lot of too big to fail banks. And guess what?
Right.
They get a funding advantage from that in terms of lower cost of capital. And that has the result of really threatening local banking.
Yeah, and I agree with that, Mr. Chopra. And Mr. Chairman, if I may, just one brief addition there. One of the things that I hear pretty consistently, and Ohio has 3 very, very significant banks, but small compared to J.P. Morgan. One of the things I consistently hear from folks back in Ohio is this fear that federal regulators in some ways treat the regional banks the same way they treat the big banks, even though the big banks have an implied lower cost of capital, because everybody knows that J.P. Morgan is going to get bailed out. But is it true that Huntington is going to get that bailout? Maybe, but maybe not. And that problem is, I think, really, really bad for the banking system that we have. I won't rehash the ways in which the Huntingtons of the world will make loans to businesses and consumers that J.P. Morgan won't touch. So I want to work to preserve that system, and I'll work with whoever is willing to work with me on that. Mr. Chairman, I yield. Thank you.